Welcome. Thanks for joining us here at Talk Tickers. Today, we're going to break down a concept that sounds complicated, but is absolutely crucial for anyone planning for retirement. We're talking about the sequence of returns risk. I mean, think about it. It's the nightmare scenario, right? You spend decades saving, planning, doing everything right, and then, right when you need that money the most, the market takes a nosedive. So here's what we're going to cover. We'll start with that nightmare scenario. Then we'll define what sequence risk actually is. We'll look at a real-world example, talk about how you can protect yourself, and then wrap it all up with a little perspective. Okay, let's set the stage. Why does the timing of a market downturn matter so much, especially right when you stop working? Well, here's the brutal 1-2 punch. To get the money you need for your living expenses, you have to sell off your investments. But if the market's down, each share is worth less. That means you have to sell more shares to get the same amount of cash, which leaves a lot less in your account to benefit from the eventual recovery. It's a really tough cycle to break. So, this whole phenomenon has a name, and really getting a grip on it is the first step to managing it. And there it is, sequence of returns risk. The key word here is sequence. See, when you're saving for retirement, your average return over 30 years is what really matters. But once you start withdrawing money, the order, the specific sequence of good years and bad years suddenly becomes incredibly important. Now, check this out. This is what I call the tale of two investors, and it really brings this concept to life. Both investors start with $1 million. Let's say over the long haul, they get pretty similar average returns. But look at the outcome. Investor 1 gets lucky, retires into a bull market, and their portfolio lasts for 40 years. Investor 2, on the other hand, hits a bad market right out of the gate, and their money is gone in just 25 years. Same money, different timing, drastically different results. And believe me, this isn't just some made-up thought experiment. There have been some major studies that put real numbers to this risk. Take a look at this research from Vanguard. What this chart shows is just how big of a difference retiring just a year or two apart can make, especially around a big market downturn. And here's the headline number. It is just staggering. For retirees who happen to start their withdrawals at the absolute worst point of a bear market, there was an 81% chance they'd run out of money during their retirement. That's how powerful bad timing can be. Okay, so now that we're all sufficiently terrified, let's talk about solutions. Because there are absolutely practical things you can do. The main goal is pretty simple. You want to avoid selling your growth investments when they're down. So how do you do that? You build a buffer. You want a chunk of your money in safer, more liquid assets. Things like cash, short-term bonds, money market accounts. This is the money you can tap into for your bills during a downturn, giving your stocks the time they need to recover without you having to touch them. A really popular way to organize this is called the bucket approach. It's pretty intuitive. You have bucket 1, your liquidity bucket with 1 or 2 years of cash. This is for your day-to-day life. Then you have an intermediate bucket to refill that cash bucket. And finally, you have your growth bucket, your long-term investments, which ideally you won't have to touch at all in those crucial first few years of retirement. So we've seen the damage this risk can do, and we've talked about strategies to fight it. But let's take a step back and ask, how likely is this absolute worst-case scenario to actually happen to you? It's really important to add some perspective here. As Javier Estrada points out in his research, while the impact of getting a terrible sequence of returns is huge, the actual probability of it happening is pretty low. It's a classic high-impact, low-probability event. All right, let's wrap this all up. So what should you take away from this? First, the risk is definitely real, but those horror stories are statistical outliers. Second, remember, this is a two-way street. A good sequence can supercharge your retirement just as much as a bad one can hurt it. Third, this isn't just about your first year of retirement. That critical window can last for 10 or even 15 years. And finally, the most important point, having a smart withdrawal strategy in place is your best defense. It's what allows you to ride out the storms with confidence.
This is not financial advice.